You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines, because what matters isn't only what happened, it's what happens next. Let's begin. What happened? Earlier today, the US Federal Reserve announced its decision to hold interest rates steady for the second consecutive meeting. This move, widely anticipated by markets, comes as inflation remains stubbornly above the Fed's 2% target. The central bank signaled caution, emphasizing that further rate hikes remain on the table if inflationary pressures persist. Meanwhile, global markets reacted swiftly, with equities experiencing volatility and bond yields fluctuating as investors recalibrated their expectations for future policy moves. Why it matters. This decision is a pivotal moment for global capital flows and investor sentiment. The Fed's pause reflects a delicate balancing act, supporting economic growth while preventing inflation from becoming entrenched. For markets, the message is clear. Policy will remain data-dependent, and the era of ultra-low interest rates is firmly behind us. This shift has ripple effects across asset classes, from equities to real estate, and even emerging markets that rely on dollar-denominated debt. The stakes couldn't be higher for businesses and households navigating this new landscape. Who is affected? The implications are far-reaching. Borrowers, particularly those with variable-rate mortgages or loans, face higher costs as credit conditions tighten. Investors, especially in fixed-income markets, must adapt to an environment where yields are more volatile. Businesses, particularly small and mid-sized enterprises, may delay expansion plans due to higher borrowing costs. And let's not forget central banks worldwide, which are closely watching the Fed's moves to inform their own policy decisions. Even consumers will feel the impact, as higher rates trickle down to everyday financial products like credit cards and savings accounts. What to watch next? First, keep an eye on upcoming US inflation data, particularly the Consumer Price Index and Producer Price Index reports. These will be critical in shaping the Fed's next steps. Second, monitor the yield curve for signs of inversion or steepening, which could signal market expectations for recession or growth. Finally, watch the US dollar's performance against major currencies. Any sustained strength could tighten financial conditions globally, particularly for emerging markets. Smart money. Neutral. The smart money is adopting a wait-and-see approach. While the Fed's pause reduces immediate pressure on markets, uncertainty about future rate hikes keeps investors cautious. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.